Welcome back to Who Knows and to one of my favorite guests, Mel Mattison. Mel, thanks for being here today.
Well, thanks for having me. I really appreciate it.
Absolutely. Mel, I got to start here because you seem very mad these days on Twitter. I
Mad?
think you got mad. I think you got to stop watching CNBC. That would be
hmm
the one
hmm
piece of advice. What are you? What's going on between you and CNBC these days?
um, well, I think, I don't know. When I watch it sometimes, I just really get frustrated because I feel like a lot of the advice, quote unquote advice, it it's not really advice. It's kind of like general market commentary about what the current situation is that's kind of wrapped up as something that's informative or actionable. And a lot of the times it's like, well, we've had a nice run up here, so don't be surprised if we pull back, but in the long run we're probably going to go up. And so the other thing that is it's combined with that, it's combined with the kind of changing of the tune of a lot of people where, they seem very convinced of things a few months ago, and then, they kind of flip on a dime and now they've completely switched. And it's just, not always called out as I see it. And I think probably the third thing, and you see this on Bloomberg as well, is there's still a group of people kind of hanging on to this Trump administration will eventually crash the market and the economy
Mm-hmm.
narrative that they oftentimes might try to disguise as if they're not trying to be political, but beneath the context of it, you get that drift, and it's like, well, the tariff inflation isn't here yet, and these are the same people that were saying in the spring we'll definitely see it by the fall. Now they're saying we'll see it next spring. I think Powell just said he doesn't expect the tariff impacts to be really felt until the end of next year. All of that may be the case that we see some of these effects. I don't think that we're not going to see some effects, but I think that this fixation this year on tariffs,
Mm-hmm.
when what we're talking about is, by all estimates, somewhere in the $300 billion range, and if you look at that and you put that in to the size of our economy, which is roughly a $30 trillion economy. So you're looking at 1% roughly. And then if you think that maybe a third of those get eaten up by, say, the manufacturers in China or Vietnam or wherever, and maybe a third get, kind of eaten up by the company in one way or another, and then let's say a third get passed on to the consumer, you might be talking about like $100 billion, which is like a third of 1% of GDP. And yet markets and the financial media have obsessed on this component, month after month, even as recently as on Friday with the tariff tweet from Trump. And I just think that what they've been doing is scaring a lot of people out of the market, convincing people that this is a bubble, telling people they need to, raise cash or, beware. And I think at the end of the day, we're still early in a huge positive upswing market, and that anybody that's kind of listening to what I would say has been the mainstream consensus for most of the year, which has recently shifted to be, bullish is now becoming mainstream. But I
Mm.
would say until as recently as a few weeks ago, there were still a lot of people who were basically saying, well, we've gotten back to new highs and maybe it'll go up a little bit. But now we're finally starting to see some people saying, hey, this AI thing is real. The deregulation is real. A weaker dollar is helpful for earnings. There
Mm-hmm.
are a lot of massive tailwinds and reasons to be uber bullish rather than, hey, now's the time to take chips off the table. We've gone up a bunch. Back off. And so I think, to me, that's just been fairly clear for a while. And so I sometimes get frustrated with some of the commentators on CNBC that I think really don't add value, and they're kind of parrots. They just kind of parrot whatever the market tells them instead of actually looking at the situation and whether they're right or wrong, coming out and making a call and saying, this is what I believe, instead of just hedging everything. Well, in the long run, we'll be up, but maybe we'll go down. I mean, that doesn't add value to me.
Yeah. I mean, those people don't add a ton of value. That's obvious. But there are also people like the Adam Taggarts of the world who are having in-depth conversations with people, and I think, correct me if I'm wrong, but he's pretty bearish. And then we've got like a guy I've interviewed who I love, Dave Collum, the Cornell professor, who's basically just saying like PE ratios have to come back to something normal, and it's way, way lower than here. And his whole thesis is therefore sort of bearish. Like, what do you think those people are missing, or what are the signals they're looking at that are broken?
Yeah. And I would separate those people from, what I would call just kind of the talking heads, and a lot of those people on CNBC, they're basically financial advisors. A lot of them, they're kind of salespeople. They don't even do economic analysis. They just kind of talk on TV, and then they have clients that they manage money for, and they have other people in their offices that do analysis and different. So I think there is a group of very well intentioned, educated, intelligent people who have been getting it wrong. Well, obviously they have been getting it wrong. That's not an opinion. The people that have been warning that this market doesn't, have a bunch of legs, and bond yields are going to spike, and inflation is going to spike, and the market's going to collapse. In the markets, if your timing is off, then you're wrong. If you say that it's going to happen in 6 months, it doesn't happen in 6 months, and then you come out and say, well, I was early, it's going to happen 6 months from now. Well, maybe it will, but respectfully, your first call was wrong. And so I think what people are missing is a bunch of stuff. Number one is just a fundamental shift in the economy and how it functions, and it's fundamentally different on so many levels. Anything prior to 1971, obviously, you're talking about a gold exchange standard time, so that's a very different period. Anything that's talking about, let's say, in the 1980s, you still have a very large manufacturing industrial sector in the United States. As you get into the 90s and the 2000s, you start getting closer to kind of the way our economy is today. But really, the GFC, the Great Financial Crisis, as well as COVID, fundamentally altered the economy, I would say, even different from the 90s or 2000s. And so looking back at kind of these historical correlations between, say, unemployment rates and the economy, for example, SOM rule was a big talking point a few months ago. People were saying we're heading for a recession, employment's going to fall off a cliff. We've had, anytime you get a 0.5% increase in the unemployment rate within a certain amount of time, then, and so you had a lot of people that have been kind of worrying about this. The most recent thing that I think people are focusing on incorrectly is private credit, talking about some of these car loans, subprime car loans, and basically painting that in like an echo of what happened with some subprime housing. And those two things are very, very different. The size of them is, I mean, the housing size was just massive, and then there were derivatives, and it was global, and it was massive amounts of capital on bank balance sheets. And when you hit the banks, you hit the whole economy. That was really the problem, right? Was when it wasn't necessarily that housing went down; it was when Lehman went down, and then that led to other banks. They were basically on the domino list to just go down one after the other, and that had to be stopped. And so, all of these things are very different. And I think people are looking at it, they're seeing these echoes, or they're seeing signs that in the past told them, the way I would put it is, if X happens in the past, then typically Y would happen. But now X is happening, Y isn't happening. but Z is happening, which is something different. And so they're kind of scratching their heads, kind of saying, what's off here? And a lot of it is big things like for example, unemployment rate. You
Mm.
know, we have a lot of people that are struggling in the country. And that's not good for society. And there are big civil unrest issues that are looming out there at all the time. The market hasn't paid much attention to it. I actually think one of the biggest threats to the market in the coming 12 to 24 months is potential civil unrest, which is something that market commentators haven't talked a lot about on the CNBCs of the world. I think that's a bigger potential to disrupt things than tariffs. If there was a major assassination, a Trump assassination, an AOC assassination, if there was something that kind of triggered this anger, and the anger is obviously developing because of the wealth disparity. Um,
Yeah.
human beings tend to, and anthropologists have studied this in tribal cultures. When you introduce something that the other people can't have, it causes problems, right? It's like this inequality or fairness issue, um, almost more than like absolute levels of things. Like, like misery loves company, right?
Yeah.
And if you're struggling and you're having a hard time with inflation and paying your bills, and you're watching the crypto bros driving their Lamborghinis, or you're watching the AI guys getting $100 million signing bonus from Meta, that's going to drive a certain group of people to say, screw this capitalist system. It's all messed up. We want Zoran Mandami. We want the government to step in and take these people's money. And so that's, I think, only going to grow. I think the Democrat Party is going through a changing of the guard, and they're leaning more socialist. This is very common in American culture. We had a socialist candidate, I think his name was Eugene Debs, in the 20s that got
Mm.
a very large percentage of the vote. I think he got 25% of the presidential vote. We had a lot of what essentially happened was a socialist uprising was growing in the United States. The Depression put it kind of over the edge, and we wound up putting in FDR for 4 consecutive terms, who more or less enacted what at the time was basically socialist policies, right? I mean,
Yeah.
for a
Yeah.
country that never had Social Security or Medicare or the taxes, so he moved the country very far left. I'm not saying that was a wrong thing to do. I'm just saying that there was a big lurch to the left in the 1930s
Yeah.
that really was, and a lot of the people in his cabinet were socialists and communists. Some of them even on the Soviet payrolls. So that's all
Yeah.
been proven in historical documents. So we had a very left wing, um, you know, uh, group, and essentially, so there's always been this socialist wing to the United States. It just was pushed down a lot when we were in the Cold War, because socialism was associated with communism, which was associated with the Soviet Union.
Yeah.
And now that the Soviet Union isn't a major threat, the socialists are free to come back out. I personally think what happens with socialism inevitably is, while in theory it makes a lot of sense, human nature is that once you start just kind of giving people things, it leads to corruption. It leads to lack of drive or motivation. And that's pretty much what you've seen wherever socialist policies have been enacted, whether it's Cuba, Venezuela, the Soviet Union. You've seen the essential collapse of these societies. China, um, which is communist in name, actually has a very free market orientated economy. And so I don't think you can say, well, China's communist and China's more of a totalitarian, authoritarian uh, culture that just calls itself the People's Republic.
Yeah.
But so I think it like if human beings were angels, like socialism would probably be a good system. But the truth is like people forget kind of the old Christian story of original sin, and you know we're kind of born flawed, right? And that human nature, even though we want to hope for the best and be optimistic, and the truth is if you say we're going to give a universal income and everybody's going to get $40,000 a year minimum, and we're going to have college be free, and we're going to have rent control, and we're going to have grocery stores, it's it's almost like what the reason why they say don't feed the animals if you're in a national park, because they're
Mm.
just going to get used to it, and they're just going to come back, and they're going to stop being that beautiful wild independent bear, and they're just going to become
Yeah.
some animal stalking around garbage dumps all day or waiting for people to hand something out to them. And you will do the same thing to a society if you start you know putting that in. That doesn't mean that this inequality issue doesn't need to be addressed. It does.
Yeah.
It's a serious issue, but that's something that's out there. So this is a long way to answer that question of what are the people missing. But I think, to get back to that is, so it's these differences in the economy where, for example, so much of the spending now is being done by these, it's capex by these large corporations, and it's also being done by the haves. So the have-nots have to buy food, they have to buy gas, and they're going to find one way or another to do that. But then as long as the haves keep getting wealthier, which they have been in the last few years of this bull run since the market bottomed out in like 23 or whenever that was, um, uh, or 2022, excuse me,
Yeah.
that basically what's happened is that spending has increased, and it's still there, and it's not going away. And so even though you have all these people that are in pain and suffering, this economy keeps chugging along because the government is spending huge, corporations are spending huge, and the wealthy, let's call it the top 10, 20% of Americans, which are the bulk of consumer spending, are driving the economy. I think for the very first time since the data was kept, I can't remember the exact percentage. I think it was 10%. Top 10% of Americans now account for over 50% of consumer spending.
It's
So,
crazy.
so even if you have that bottom 50%, they're almost got this minimum spending level that they have to spend to survive. And no matter how much they're struggling, somehow they're spending that, whether it's
Hmm.
with food stamps or Uber driving or whatever. And then you've got this other group. And so the economy is going through these, there are these difficult issues. So like people will put a chart up and they'll say auto loan are going delinquent, and that means the consumer is struggling.
Yeah.
No, the consumer's not struggling. The bottom 20-30% are struggling, but they impact GDP very little. And GDP is not the markets. The markets is earnings, it's corporations, it's a weaker dollar from overseas revenues, all of these things. And so there's this disconnect between the employment picture, between GDP, and between the markets, and they're all saying different things. Um, the lower deciles are saying the economy is in a tough spot. GDP is saying we're like mediocre, but corporate earnings are soaring. And
Yeah.
so if you're looking at a market and you're basing it on GDP or how the bottom 25% are doing, you're going to get it wrong. You gotta look at how are these companies doing, and these companies are doing extremely well. And
Hmm.
AI is only helping them even more because they're not needing to hire like they used to get the same stuff done. So there's all these great things for corporations, these great things for the wealthy, and I think we're slowly starting to turn the table um, with the administration's plan to start helping the bottom 30-40%. We just had a big announcement yesterday, $14 billion by Stellantis, which owns like Jeep and Ram. They're going
Yeah.
to be opening plants, reopening plants. building cars, 5,000 plus automotive jobs. That's 5,000 good jobs that pay wages, that have benefits, that then go into a community, that then allow restaurants. So we're starting to see it, but we're not seeing it yet. And my hope is that over the next few years, we're going to start to see this AI build out. They're going to need people to build these data centers. They're going to need people to wire them.
Yep.
These are all jobs you don't need a master's degree for. And hopefully that's going to happen. And we're going to start to fix it, because otherwise we're going to go more and more
Yeah.
to the position of socialism is attractive.
Yeah, man. It's crazy because the people that want socialism, we're all seeing the same problems. And like, yes, you're correct. Those problems exist. And then they're probably they're misdiagnosing what's causing the problems. They're seeing the right problems. But when the expansion of the money supply, like so simply just if you have an asset, if you own your house and they print 40% of all the dollars to ever exist in the last 5 years since COVID, your house goes up in 40% in value. So you're just wealthier for doing nothing. And if you don't own a home, trying to buy a home just got 40% further away from you. And it's so simple that the expansion of the money supply basically forces people out of the middle class to one side or the other. And then the weird thing is when you throw on AI, like you just talked about there at the end, on top of it, it's almost the same thing again. This is how I'm viewing it, but AI could either take your job, or if you own your own business or your company lets you use AI, you're all of a sudden way better at your job. You're more likely to keep your job. Your business actually performs better as a result of it. And there's almost like no staying in the middle again with the AI thing. So I think we have it feels like we have two forces pushing people out of the middle. Do you think AI is starting to make an impact like that now, or is that
Mhm.
more in the future? How would you view that?
Well, I mean, I do think that there's going to be turbulence in the labor market caused by AI, but I don't think that that means that we're heading to a world where there will be no jobs. And I think
No.
what AI is doing is it's impacting it and will impact white collar people first and a lot more.
True.
And that the non bachelor's master's degree holding people, I think frankly that they're heading for a much better environment.
Yeah.
I'm positive, I'm optimistic, because the way I look at it is there's just so much stuff that we have to do in this country, from an infrastructure perspective, from a grid perspective. Um, we have an elderly population that's aging that needs care. Because a lot of some of these, you know, infrastructure or engineer, like some of these jobs skew highly male.
Hmm.
And so, there are other jobs like elder care that skew high female. Um, I think obviously, in today's age, that we'll see women putting on hard hats and going out there and building, and obviously there are already, but we'll see even more, because people will say, "Hey, there's a job there." A
Yep.
show I like to watch sometimes is Gold Rush, and a lot of the people they have driving the tractors and manning the cats are young women. So just because you're a 26-year-old woman doesn't mean you can't handle a big piece of machinery. So I think we'll see women getting more into construction, infrastructure, and in the and in fact, a lot of those things are very kind of dexterous hand things that, it's not like the old days where it's like carrying
Yeah.
sacks of bricks around.
Yep.
Um, so, so there's going to be a lot of opportunity for both sexes in this uh, build out that we need to do, because the country is just getting old. I mean, the bridges, the roads, the U.S. interstate system was put in basically in the 50s. It was, an Eisenhower thing.
Yeah.
All this stuff, it has to be addressed, and it can't just be allowed to crumble. And the problem that a lot of people see is what they'll say is, Mel, you're right about that. that's going to require a bunch of government spending, and that's going to be, massively inflationary. And I don't hold that view. I don't hold the view that we're heading for this massive inflationary situation, because, as you mentioned, like, what happened in COVID was like printing like 40%, increase in the money supply, and then essentially just handing that to people in
Mhm.
cash. And and that's of course going to be inflationary. Like, if you just give a bunch of money to everybody, and then they're locked in their homes, and then they can only buy goods, and those goods aren't even getting here because supply chains are disruptive, then goods are going to go up. If you do that, when we opened up and now everybody wants to go on a trip because they haven't gone on a trip, all the hotel rooms, like, everything surged. And it
Yeah.
was that monetary influence of increasing the money supply, and it was also kind of the way it was done. And I think that while there's going to be higher inflation than what we've had in the first, 20 years of this century, going forward, I think, like, CPI levels, which, can be manipulated and don't tell the whole debasement story. They might print 3.5%, maybe even 4 in the coming
Mhm.
years, but the real debasement will be even bigger. And I think that's why you're seeing gold do what it's doing. Eventually, I think you're going to see Bitcoin start to participate as well with that. Um, but I think what we will do is and you're seeing, like, because energy is a big input to things, like oil is still under $60 a barrel. um
Yeah.
you know we're gonna walk this tightrope of higher than 2% inflation, but I don't think we're going back to the 8-9%
Mhm.
type of stuff we saw in 2022. And hopefully what we'll see is real wages keep up with that 3 or 4% inflation, because of the demand for a lot of these working class jobs, because of the AI build out and the infrastructure needs, the retirement of the baby boomers. We'll see a lot of that eventually funnel into those wages. The kind of category that gets a little tricky, and we're seeing it in the data when we get the data, is recent college graduates aren't
Yes.
having the best time. And there's also a table in the unemployment releases that breaks it down by sex and whether people are native born or foreign born. And, like, the unemployment rate that's been rising the fastest in those kind of four groups, native born men and women,
Yeah.
foreign born, is native born women. Have
Yeah.
been, and those are the group with the highest concentration of kind of white collar. So, I think what you're seeing that get disrupted, and you're seeing people move into entrepreneurship. But that's not the answer for everybody. And I think there's going to need to be um, social things put into place to help with that, but that we're going to have a bit of a transition there. And it will be a negative. Not everything is perfect, but I think we'll eventually, kind of get through that, and that eventually AI will create new types of jobs that we're not
Mhm.
even imagining right now. And there's no shortage of things that need to be done. And so we just need to figure out, how do we get people uh, doing what society needs.
Mm. Um, you mentioned gold in there, and I obviously wanted to ask you about that because, like, the way when I have conversations about what's going on with people that don't really follow this stuff, I kind of put it like this: basically, gold has been money for 5,000 years or whatever, 6,000 years, and it's up
Hmm.
60% in value in 10 months. Like,
Hmm.
add to that, silver's up 70% or something in this year as well. That's telling us something. What do you think is what's happening
Yeah.
with gold, and what's it
Well,
telling us?
yeah. I mean, there's a lot of big things happening. One thing with gold in particular, is it's becoming money again. It's being bought by the central banks again. Um, you know, People have to realize that when we went off the exchange standard in the 70s, we entered a multi-decade period of central banks selling gold. The Bank of England sold almost all of their gold, at like $300 an ounce or something like that. You know, and so central banks hold massive amounts. I mean, they don't measure their gold in ounces; they measure it in metric tons. So when you have central banks out there selling gold into the market, that's obviously something that's going to keep the price depressed. And once you take that away, and not only take it away, but flip it from
Yeah.
these central banks that are, instead of selling metric tons, they're buying metric tons, and you've done that dynamic. That's a fundamental paradigm shift in the market. It's a multi-decade shift that has happened. I believe it began in like 2014, when central banks flipped from being like net sellers to net buyers. But the trend has been in place, and the trend is growing. So you have that central bank demand, that sticky demand. They're buying it programmatically. They're price insensitive. They're holding it for forever, basically. And then what you do is you have people catching on to that, and then saying, "Oh, I want some of that too." And then other people see that central banks are doing it, early adopter investors are doing it, then they want to get into it. So then you get the momentum play on top of that, like the people that are just short-term traders going in and buying it. And the other thing about gold and silver in this respect is, for a lot of the world, gold never really lost its kind of value as the way you hold wealth. So for huge chunks of humanity, 1.4 billion people in India, for example, gold and silver have been the traditional way to hold wealth. It wasn't, they weren't necessarily wealthy enough to have land. They didn't invest in the stock market, but that Indian peasant could have that gold necklace passed down from the grandma to the grandma. That was their safety net. That was their inheritance. That was their family net worth. And so there, I think just this week, Vietnam had a restriction on holding gold for individuals. They lifted it, and there were lines out the doors, and not enough gold to sell to the people of Vietnam that wanted to buy physical gold. So huge amounts of the world have always, looked at gold, and it's actually, they've been doing it for a while. And it's finally this year that now the Western investors have said, oh, there's this value. And now this debasement trade narrative comes out there. So it started with central banks. Then it really went with, Chinese who can't own Bitcoin, who have a closed currency, but they can't own gold, and the Vietnamese and the Indians. And now you're getting, people in London and New York, and everybody wants gold basically at the same time. And so I don't think that this gold run is stopping anytime soon. I don't think that 4,000, 5,000, 6,000 is where it ends. I think it ends in five figures. I mean, it's not going away. Does that mean I think it's going to 5,000 this year? It could, but I doubt it. I think this run is getting a little long in the tooth, and that group that is just the speculative momentum investors, at a certain point, once they see that momentum slow down, they're going to rush in to take profits and sell. And we could see some really big down days in the gold and silver market in the weeks and months ahead. We could see $100-$200 down on gold, in a matter of hours, when you have this type of a run up. But most people around the world will look at that as, okay, this is a buying opportunity, because the trend of gold being money again is not going away, and they want to be a part of it. So I think gold has always served this role. I don't think it's going to be replaced by anything. I think Bitcoin is working to become a digital addendum. And the beauty of these things is that when you look at something like the stock market or real estate, you can say to yourself, this is just too expensive. Like, this company has no revenues, and it's trading at, or no profits, and it's trading at 100 times revenues. Like, this is insanity.
Mhm.
There's no price that's insane for gold. right? There's no
Yeah.
price that's insane for Bitcoin. There's no earnings stream. There's no, and a lot of people look at that, and that's the reason why they don't like it. They're like, why do you want it? But it serves this purpose. It serves this purpose as this neutral reserve asset, this asset that it can't be printed, it can't be conjured out of thin air, and that important groups around the world, central banks, actual banks. So gold is considered like a tier one asset on the balance sheets of a Citigroup or a Wells Fargo, or so. So the kind of powers that be in the economic world acknowledge gold as this special thing. They don't acknowledge silver that way. They used to, but silver became demonetized in the crime of '73. It was called in 1873, when
Mm.
we kind of moved away from a bimetallic standard in the United States.
Yeah.
Um, so so silver still has some of those components, but it's not pure money in the way that gold is. JP Morgan famously said gold is money, nothing else. And so as long as that's accepted, and that became out of favor for a long time after the gold standard was abandoned, and that's coming back into favor. I think that was just a blip. That was a 20, 30-year anomaly where people said gold isn't money. And I think the world is returning to say, especially in this fiat world, when you look at the amount of debt that the Japanese have, that the Europeans have, that we have. I mean, how can you say the yen is money, or the euro is money, or the dollar is money, when it can literally be typed into a keyboard and a trillion more are created?
Yeah. Well, I think a lot of people probably miss when you say gold is money. They're just thinking they can't go into Starbucks with a gold coin and buy a coffee. Like, I think we've been taught almost across the West that money is just medium of exchange, which is not true. It's also store of value. And so when you're saying gold is money, you mean it's a store of value. It preserves the work you've already done and value you've brought to society. But let me ask one follow up on that though, because what I get, if central banks are buying gold, that's what's causing price to increase. There's more demand for the generally same amount of supply. But why do they want more gold when they didn't want it 2 decades ago?
Mm-hmm. Yeah. Well, I think, the question kind of what is money? Like a lot of times there'll be four things that people will say, right? There'll be a unit of account, a medium of exchange, a store of value. Um, I think there might be one more that I'm missing, or maybe it's those three
Yeah,
are
those are the three I know.
the main three.
Yeah.
Um, what the thing with gold is, so if you want to make something a medium of exchange or a unit of account, you can, right? Um, but what's hard is to find something that really is a store of value. And so,
Yeah.
and so, like, I think we will be moving to gold. It's not necessarily like people are going to be back to using gold coins, but you're starting to see some of the large stable coin providers, instead of saying, if you want to get a stable coin and we'll hold it back by UST bills, we'll have a stable coin where when you buy it, it's bought at whatever value the dollar is. So you put $4,000 in, it'll be backed by 1 ounce of gold, whatever that 1 ounce of gold goes up or down. And people might start buying or selling with that. But the transaction mechanism is that gold is just in its physical form, has always rarely been used. For hundreds of years, it's been rarely
Yeah.
been used in the physical form, right? I mean, it's been bankers' notes and different things, or gold-backed bills. That when we were on the gold standard, people still used paper bills a lot of times, but those bills were theoretically backed by the metal at the central bank. So yeah, gold is cumbersome in that way, but you can back it on the blockchain now, and you can do that. And the thing is like, what the dollar is good for is it is good as a transaction mechanism, just because everybody takes it.
Yeah.
And fundamentally speaking, like the US government, takes it for taxes. And there's a whole school of thought related to modern money theory that, like, what really, gives money its value is that the sovereign power accepts it for payment of taxes and fines. And whatever the sovereign power accepts as payment and taxes and fines is therefore going to have value. And that this is kind of how money actually got started, is that somebody might kill somebody's son, and the chief would say, well, you need to pay 6 sheep, or we're going to kill you, to the family of the son. And that, eventually they then said, well, we'll pay, maybe X amount of barleys or grains. And if you look at gold measurements, there's grams, but the smallest weight that people measure gold in is something called a grain. And a lot of these things go back to um, agricultural commodities, like the terminology,
Mm. Hmm.
even like the pound, like this weight is like a pound was like equivalent value of a pound of grain.
Hmm.
And so these these are kind of the original, like, I mean, money, the way it got created in the beginning, it really tended to be a fine, a payment for a wrong, and recording these fines and payments and debts were really how writing started. So if you go back to the
Oh,
Sumerians, and
wow.
the first writing that we have, it's the recording of debts and fines. And so
It's crazy.
what, yeah, like loans and debts and money predated writing, and were instrumental in creating writing, to track, units of account, basically. And so all of this stuff goes back, like, tribally. And that's why when you look at some of these tribal cultures, they'll use these weird things. Like, there's that famous culture in Polynesia that use these big cement, like donut looking things, as money.
Yeah.
And the Europeans came and they wanted gold, and they looked at people and they were like, why do you use these things? And they were like hard to move around. And, I mean, it was just kind of, it made no sense, but it served the purpose. And so
Yeah.
gold serves that purpose. It still serves that purpose. Like, if China wants oil from Saudi Arabia and they don't want to use dollars, China can say to Saudi Arabia, okay, I'll give you 200 billion yuan. You can use that 200 billion yuan, the Chinese currency, to buy things in China. And then I'll give you 2 tons of gold, and you hold that gold. And then when you need more money, you can take it to the Shanghai Gold Exchange, or they're setting up exchanges in Riyadh and different ways to cash that in when they need to. And so gold just serves this purpose, and it serves it independent of the SWIFT network, independent of the
Yep.
US dollar, independent of the treasury regime. So yeah, all of these things are coming in all at once, to just make gold the perfect investment this year. And I think that until those fundamental factors change, gold's going to go up in the medium long term. I think right now uh, is not the time to be adding to your gold position. It was about 2 months ago, as I posted on
Yeah.
X, when we were coming out of this long consolidation phase after we hit 3,500. And I said, now's the time to buy January gold options when gold was at 3,600. And at this point, we're long in the tooth with this. But
Hmm.
uh, longer term, I mean, I think 5,000 next year is probably very realistic.
Wow. Well, let's go back to your 10 predictions then from New Year's Eve, 2024. So about 10 and a half months ago. Um, and we've talked through a lot of these in different ways, but I'll go through and kind of give you a little scorecard. Then we can talk about each one. So you said on New Year's Eve there'll be a 15% correction in the S&P 500 in the first half of 2025. You were correct. The S&P 500 will finish up this year greater than 15%. In the 7,000 range, we're at like 66, 6,700 now. So I'd say we're on track. It hasn't hit yet, but we're on track. You said gold will break 3,500. That's correct. We're above 4,000. Bitcoin breaks 150. You could say potentially on track for that. We hit 125, and we're been above 100 for a long time. That's potentially on track in the next couple months. Fed cuts at least 100 basis points. Say that's probably the only one that's not going to happen. Maybe they've cut 25 basis points, and they'll probably cut maybe two more times. So I'm guessing you'll be close on that, but maybe that one's not true. QT ends, which I think it was yesterday. Powell said we could stop balance sheet contraction in the coming months. So that looks to be on track. The DXY ends the year below 100. We are at 99. Emerging markets outperform the S&P 500. That's true. Volatility returns with VIX going above 20 and 30 numerous times. That's true. That's already happened. Doge does not reduce the deficit, and that is true. So I've got 6 have already completely come true, and these were not easy predictions. I'd say 3 are on track, and I'd say the only one that you're going to miss by a little bit is the 100 basis point cuts. Is that a fair scorecard for your 10 predictions right now?
Yes, I would agree. I do think there's a small chance they cut 100 basis points this year.
Yeah.
If
Yep.
we get a weak employment report and benign inflation, you could potentially see a 50 basis point cut at one of the next. There's 2 more meetings.
True.
One at the end of this month and one in December. But in all likelihood, the 100 basis points of cuts will probably come true in January. So I'll probably be a month off on that one.
Yeah.
I think that all the other ones, like you said, there's like 6 that have happened, and then there's 3 that still could, and I still believe they will, which is, I think, Bitcoin 150. I think we will by the end of the year. 7,000 range. So by that, I would say 6,800 to 7,200. But if you want to be tighter, maybe 6,900. We'll get. I think we're going to get in that 7,000 range, at least within 100 points of it, if not above it, on the SM. And then the third one that hasn't happened yet, that I think will happen, was, well, the Dixie will end the year below 100, or QT will end. Yeah,
QT ending.
Yeah. And Powell did come out yesterday and said if it's not over by the end of the year, they'll probably be putting the plan in place. And they've already reduced it this year, and now he's basically saying they're going to reduce it more, and it's going to end soon. So, yeah, those are pretty good. A lot of people, and like you said, a lot of them were very contrarian at the time. They seem obvious now, but like a lot of people thought about American exceptionalism, and to say emerging markets were going to do better than the S&P was kind of crazy. A lot of people thought the dollar, was strengthening. They didn't see the DXY collapsing. Also, we were at a high, and a lot of people were like, the Trump administration's coming in. Why are we going to sell off 15 or 20% in the first half? And then not only did I say we're going to sell off, but that it's going to be basically quick, and we're going to get back and close the year up 15%. So I was basically saying we're going to have a 15+% sell off, and then end the year still up 15%. So, it was a good year for me as far as where I was seeing things going. I think right now, I actually started talking about this a little bit on X on Thursday of last week. So before Friday's big drop. But what I really see happening in 2026, and what I think will kind of be the basis of my outlook for next year, is that while I am bullish on things, I think that, and it seems like I'm saying it after the fact, but this was my thought process already, is that we're going to have a lot more volatility in markets. So you've been seeing it all week. This week, we were up very high, just an hour ago. Now we're coming back down. And it's been up and down all week since Friday, just really big moves. And I put a post out kind of showing the NASDAQ during the dot-com boom of the 90s, from like the 95 to 2000 period. And we had four major pullbacks in that 95 to 2000 period in the NASDAQ. One was a 28% pullback, and we had three 13 to 14% pullbacks. Three of those occurred within like a 10-month period in 1999. So we literally like went down 10%, got it all back, went to new highs. A couple months later, went down another 12%, came back all highs. A few months later, went down another 13. So basically what the point of that is that in extreme upside markets, you also get extreme downside moves. And so people, I think, could misread let's say what's been happening this past week with volatility as we're nearing a market top. This is, time to sell everything and get out and take profits, because, we could see a 10, 12% correction. We've already had a 3.5% correction in the NASDAQ. Could we have a 5 to 7 or a 10? Yes. But what I would say is that the longer term is extremely bullish. So this would be where I'd be a little different consensus, because I think a lot of people are going to see this year be very strong, and the CNBC people will be coming out in January and probably saying what they say almost every year, which is like the market will go up like 10%, which is what the long-term average of like the S&P 500 is, like 10%. So if we end the year around 7,000, people will be coming out with their end of year targets, 7,700. I think it's going to be well over 8,000 by the end of next year on the S&P, because I think we're entering into this, boom period where earnings are going to be good. The regulatory headwinds are going to decrease. There's going to be tax incentives kicking in from the One Big Beautiful Bill. We've got all this stuff happening in the AI world that I think is still early. And so I think all of this stuff is coming together. It's going to be another super strong year for equities, for gold, for Bitcoin. And I think that accompanying it is, unlike this year where we had this dramatic big sell-off, and then we had this slow but steady, like almost unstoppable march for the last 6 months of just the market going up seemingly every single week almost. We're going to have a lot more, like, it's going to test investors' resolve, because they're going to see, some big dips happen. And we could be seeing the first of those happening, I think, in this period ahead of big tech earnings, Federal Reserve, and the Asian meeting, all happening around the end of this month. And I think, especially for the next 2 to 3 weeks, we're going to be in this hyper volatile situation, because we got those three big, huge things that the market wants clarity on. They want to know, how are the earnings looking for the big guys? They want to know, what's the Federal Reserve message? And we haven't been getting economic data. So, we'll get CPI report in a couple of weeks as well. And then the Trump meeting, I think, is going to be a big positive, and that he is going to come out of that with a deal, maybe not even just with China, but also the president of Brazil is going to be at that meeting in Asia. And I think if we get some sort of a big agreement, it would just be like a memorandum of understanding between like Brazil and the US, between the US and China. Then we get good earnings from the mega caps, and then we get a dovish Federal Reserve, and all of that gets confirmed at the end of this month. Then you could see it really rip higher into the end of the year. And that's my forecast right now, is very high volatility here until I would call it like November 7th. And then once we get past those three big unknowns, I think they're going to all resolve favorably, and we're going to go higher. And that would be like a difference between me and a CNBC person. CNBC person might say, if all three of those work out, then we'll go higher. If they don't, then we won't. Obviously,
Yeah.
if earnings are bad and the Fed's hawkish, and obviously, what I'm saying is, yes, those are the big catalysts, and yes, here's my view on what the outcome is going to be. It's going to be positive, and it's going to be a very strong run up to that 7,000 number. And don't get spooked out by this volatility that you're seeing right now. As we've been speaking, the market's been going down quite a bit, but it's still not breaking that level that we hit on Friday. And in fact, it's still higher than the lows yesterday. So we're just seeing it go up a bunch really quick, go down a bunch really quick, and expect a lot more of that in the coming weeks. And expect there to be a lot of periods like this next year where volatility is much higher than what we've gotten used to in the last 6 months.
It's going to be interesting for all the people that say they don't like Bitcoin because it's too volatile, and now their 401k is just turning into Bitcoin.
Yeah, it really is. It really is, and it's actually the way equity markets have been for a long time. I think prior to like like a 1% move was very common. It was almost like the average move on a daily basis 20, 30 years ago.
Okay.
And a lot of the volatility has come out of these markets in recent decades. We're going back to a lot of the things that we had in the past. Like a lot of people have talked about the 1990s or the 1920s. I actually think one of the best corollaries to the type of period we're in right now is the 1950s. And the 1950s was a better decade than the 1990s. The S&P averaged over 19% return over the 10-year period of the 1950s. In the 1990s, it averaged 18%. So good,
wow.
but there are a lot of people that will say, like, people are getting used to the market going up 20% every year. It can't do that. Well, over a 10-year period, it can average that. So there were some down years in the 1950s, but then there were some really big up years, like 45% up year. I think 1953 or 54 was a really big up year for the S&P. And so what was happening in the 1950s, why I think it's like now, is in the beginning part of the decade, you had this massive influx of people into the labor supply because people came back from the war, right?
Yeah.
And then in the very beginning of the decade, a lot of those people were not yet in the system because we had the Korean War flare up from 50 to 52. And then in 53, there was a recession and the markets went down. And that to me would be a little bit like 2022, where we had a bear market in equities. And then we came out of that, and the government realized that without World War II, without the Korean War, we need to basically get people to work or we're going to have problems. And that was when we did two main things. One, the U.S. had never really maintained a large defense base, but we did. We essentially, this was the time of the development of the military industrial base. We did massive infrastructure. This was the time of the interstate highway system was put into place. And we also did massive stimulus, massive, essentially, money printing in a sense, in that we were just helicopter dropping money all over Japan and Europe with the Marshall Plan, because we needed to get those countries going again and rebuilt. And we're seeing, Europe right now talking about they need to do more spending, more defense spending because of Russia. But I think really what they need to do is they need to get their economies going. And Germany is only like 45% debt to GDP. They have a lot of room to borrow and to spend. And so we're seeing stuff happen in Japan. We're seeing essentially that was the first decade of the Cold War. We're seeing this kind of uneasy tension between the United States and kind of the BRICS coalition led by China. And so to me, we're kind of having a little bit of, we had that space race get started with Sputnik in the way that
Yep.
there's an AI race. So there's a lot of corollaries and ways that I could draw parallels between the 50s and the 2020s. And if you look at how that was for equities, it was a fabulous time. We also had relatively high inflation. So I think, there's a lot of things that you can look
Hmm.
at and say, it doesn't have to end necessarily. It doesn't have to be like a dot-com boom. That's one possible scenario. But there also is the 1950s, and it kind of continued actually even into the 1960s. And then we topped out in 1965, where equities just got ridiculous, and we essentially had like a lost decade, where equities returned nothing for like over
Hmm.
10 years. And we could be heading for one of those situations, but these situations can last for quite some time. And we're only 3 years into this. If you go back to the 2022 bottom in October of 2022, or if you want to go back and say, when did we really break out from, say, 2021 highs? We peaked there, and then we didn't get back to there until 2023. So maybe we're only 2 years into it,
Yeah.
um, since we hit a new high. I mean, so I don't know how long it's going to last exactly, but all the fundamental drivers that have made me bullish this year, I still see in place, if not even more so. And
Huh.
so I'm not changing my tune that we're just because we're having volatility this week, that these are signs that the end is near.
Cool. Um, Final question, I think. When are you coming out with the Mel ETF so we can just track what you're doing instead of read about it on Twitter?
That would be a great thing to do. I would love to do something like that. You can do stuff like that I need to sign up a few big investors.
Yep.
I'd need some core good people ready to move some big money, and then I could put a phone call into Goldman Sachs. They have services that allow you to launch an ETF like that. Warren Pies does
Wow.
that with his research firm. Um,
Hmm.
so that would be a great idea. I don't know if I'm quite there yet. Maybe if I have another year in 2026, like I've had in 2025, uh, there'll be some of those folks out there that say, "Hey, I'll put 10 million in your ETF to help you
True.
going." I get three or four of those guys, and I get like a 40-50 million dollar seed fund for it. Goldman
Yeah.
Sachs would be happy to spin one up for me. So we'll
Wow.
see. We'll see. I've thought about it. But I
Yeah.
don't think I'm there yet. I've had some people reach out to me, um, for management services and things.
Yeah.
Um,
I bet.
and I do a little advising and consulting, uh, for some ultra high net worth people. But don't, uh, I don't know exactly, if the ETF is anytime soon, but I think it's possible. It
Yeah.
just, there's a lot of opportunity out there. I love managing money, but right now I'm kind of happy managing my own stack and not
Yeah.
having clients to answer to, which is
Yes,
also
I hear
nice.
that. Yeah.
Mhm.
Well, and then since you're a versatile guy and you're also an author, I wanted to check in on Quoz. How's that been received and how are book sales going?
Book sales are good. It's a timely book. I mean, it's
Yeah.
basically about quantum computing and AI essentially getting involved in the financial markets, and behind the scenes, there's these central bankers from Russia, India, and China, kind of plotting a gold-backed overthrow of the U.S. dollar. Uh, it's really a great book for people that like thrillers, like think like Tom Clancy type thrillers, but with a instead of the CIA and spies, it's all about like psychopathic central bankers and the Bank for International Settlements in Basel, Switzerland, and dollar collapses and gold bullion transfers and stuff like that going on. So if you're into that sort of thing, a thriller with those types of themes, I think it's a perfect book. Those that have bought it, the reviews have been really positive on Amazon and stuff. It's
Yep.
available wherever books are sold. There's an audio version on Audible and anywhere there's Audible books. I guess Apple has a service too that does that. It's available all those places, distributed by Simon and Schuster. So if people want to pick up a copy or download it on their phones, it's there.
Cool. Yeah, I'll link to it. I'll link to your Twitter account. Anywhere else you want people to go?
No, that's it. I have a website, melmattison.com, but
Yep.
it's kind of static, but it's just kind of some more information about Quoz and stuff. But on X is the best place to stay in touch, and I'll be posting some updates as we get closer to the end of the year on what I think 2026 has in store. And in the meantime, I pop random things, and sometimes I do uh, I'm not a professional Twitter. Like I don't have like a research firm and stuff. So my Twitter can be as all over the place. With
It's pretty raw. Pretty raw. It's good.
I might be throwing down some beers on a Thursday afternoon and just go off on CNBC or something. So like I said, it's not a research firm. It's not a company Twitter. It's a
Yeah.
personal Twitter account.
Yep.
So it's all over the place.
Well, it's good to see you've also like 10 to 15 extra followers from when we met, and I'm sure you got a lot more upside on that front too.
Yeah.
All right. Well, Mel, it's great catching up. I love hearing how you think through all this stuff. So thanks for coming on and talking with me on Who Knows.
Hey, thanks for having me, Henry. Really appreciate it.